as our guest for today. Before we start with the session, I would like to introduce Param Investments briefly. As most of you know, Mr. Rahul Khatri founded Param Investments in 2005, and since then, we have been guiding families and individuals towards their financial goals. The company began small with 3 members with a vision of trust, transparency, and long term relationships. Now, under Mr. Khatri's leadership, it has grown to 18 team members serving clients across generations and different countries. At Param Investments, no client is too big or too small, and everyone receives the same commitment, respect, and transparency. I'm truly humbled to say that this is our 8th investors meet since our inception, and immensely grateful to all our investors for their overwhelming support and response, and most importantly, their trust bestowed in our company since last 20 years. To talk more about 20 years of splendid journey, now I call Rahul sir on stage to share a few words.
Thank you, Purti. Good morning to everyone. Before we begin, I would like to pay tribute to our soldiers who have been guarding our country and keeping us safe 24/7. I would like to thank Mr. Tahir Bacha for accepting our humble request and giving us time on this Sunday morning. This will be our 8th edition of the Investor Meet. Many people come to us and ask the reason for holding such events. As all year round, you have been listening to us. One day, we feel that you should be listening from the investor or the expert's mouth itself and understand the markets and the field of investments. Param Investment completes 20 years this year. I remember the day one when I opened the office, right from the beginning till date, get a lot of encouragement from all of you sitting over here as well. Without you all, we would have not have been here. A big thank you to my team at Param Investments, and they have been giving 100% to us and to everyone sitting over here as well. I really thank each one of you. I would just like to invite Purti to give us a little more brief about Mr. Tahir Bacha.
So, Mr. Badshah has over 30 years of experience in Indian equity markets. As a CIO of Invesco, he is responsible for equity and fixed income investment function at the firm. He has been with Invesco India for about 8 years. In his previous role with Motilal Oswal, he was responsible for leading the equity investment team. In the past, he has also worked with companies like Kotak Mahindra, ICICI Prudential, and Alliance Capital Asset Management Company. Mr. Bacha holds a master's degree in management studies with specialization in finance from SP Jain Institute of Management and an engineering degree in electronics from University of Mumbai. It's a pleasure, sir, to have you here. Now I would request Riddhi ma'am to come on stage and felicitate Mr. Bacha with a token of gratitude. So you may start the session now.
Thank you. So your name is? Murthy. Thank you, Murthy. And good morning, everybody. It's nice to be amongst people who show this commitment towards, investing and and see that as an important part of their overall, life journey. I think at our end, with committed people like Rahul and several others who are trying to promote investments as a culture, I see myself and the role of mutual funds at large as being not in just in terms of managing money and trying to give you a sense of what markets, etc., but basically trying to help you in your wealth creation journey, trying to help you in the process of developing financial discipline and an investing culture, which I'm sure will be something which will last, many decades and benefit not just you but many generations to come. So once again, let me begin by thanking all of you to being here at early in the morning on a Sunday to come and listen to me. It's a privilege and an honor. Thank you, Param Investments. Thank you, Rahul ji, for having me here. Today, at an aggregate level, my idea will be to probably, I'm sure you want to listen to a lot of stuff about markets and how to navigate current market conditions and economic conditions. My effort at the end of the day, at the end of this session, would probably be to try and convince you that no matter whatever is going around us, in several ways, I think at an aggregate level, we are still in the right direction as an economy. We still have a lot to be happy and proud about where we are in terms of our economic as well as investing journey, and that's something which should give you, hopefully at the end of the session, that conviction to stay on course, not get distracted by many developments around us. Events, developments are a part of the market, a part of an economic evolution, and it is important that we are able to understand that threadbare and probably not get vitiated by it, and continue to be remain committed on that investment path. So that is, if I can probably achieve that at the end of this session, I will probably be happy about it. What I'll do is, I'll try to begin with some kind of color in terms of how we think about the markets today, and I'll try to dissect it from 2-3 different perspectives, the global perspective and the domestic perspective. I will try to also, as instructed by Rahulji, to keep it as simple as possible. But the world is getting complicated, so there will be few things which will in any case sound complicated. But nonetheless, my idea is not to probably throw a lot of jargon at you or confuse you. Idea is to try and simplify things as much as possible. So please bear with me. Even if you probably have not understood anything, please feel free to either stop me or probably even we can take it on later as Q&A. I'll try and leave aside a fair bit of time for you to bring up some important questions that you might have in your mind. So let's begin by giving you I don't know whether this is very visible for you guys, but I will try and probably explain a few things. And so today, as we stand, I'll manage. Today, as we stand, the overall global economic picture is not too bad. It seems quite okay. That is important to understand, because in the current confusion of things, it looks like we are in trouble as far as global economic growth is concerned or global economic trajectory is concerned. It is not currently, as things stand today, it is not as bad. It is pretty fine, both from a global developed market perspective as well as from an economic India domestic market perspective. But at a high level, there are going to be certain changes to the global economic trajectory as we go forward, and especially given today that we have this situation about the global trade wars, which lot more milder compared to probably what it began with on 2nd of April. This at some level is also a turning point for the economies around the world. There will be a few changes. The world probably will be a different place. But today, as it stands, things are still okay and well within control, both from an overseas as well as a domestic India standpoint. When we talk about India equities, we think that there is uh, we have been in a positive cycle from an India economy standpoint and from the Indian market standpoint as well. Since COVID. Since COVID, we have been in a good, decent upcycle. I believe this upcycle probably is here to stay. We've had, within this upcycle, we might have some small subcycles which might be up and down, but overall the cycle is still on an upward journey. We had a small dip or a reversal, a minor reversal that we saw in the later part of 2024, second half of 24, which created some amount of anxiety in the market when growth started to kind of slow down, especially after the very heavy growth that we had seen, that we had been used to seeing post coming out of COVID. And that created some amount of anxiety, as I said, in the market. However, I think as has been seen of late on a good number of occasions, government as well as institutions alongside, for example, the RBI, they have been quick to identify spots of trouble and come about and quickly rectify the situation. We saw that happen in the since the early part of this calendar year, and I will talk a little bit about it in detail. But as a result of which, it looks like we are once again likely to see growth start to build up, accelerate as we go ahead. Notwithstanding even whatever is happening around us with regard to geopolitics and the confrontation that is, which India is going through right now with Pakistan. However, geopolitics obviously has that ability to create short-term volatilities in the market and create situations in the mind of investors that are we on the right track? What does it mean for equities? Is it something which is going to be a lot more prolonged? I think those questions, they are valid, they are legitimate to arise in the minds of people. But while it induces short-term volatility, I think if you go back and look at the history of different kinds of conflicts and confrontations which have happened around the world, whether in our region or probably in other regions of the world, generally 2-3 things which I have observed. One is that no war lasts for a very long period of time. Okay, they are maybe a few weeks to few days to a few months and perhaps a couple of years, but beyond that, I don't think wars are very prolonged. If they are prolonged over a period of time, they lose intensity. So even if you were to probably think of, let's say, a Russia-Ukraine conflict which began in 2022 and it started off with the assumption that it will end in a few weeks or in a few days, which it didn't. And even today, actually, at some level, 3 years later, it is simmering in the background. But it has now got to a stage where, by and large, the world has moved on, the world has become indifferent, and even that war at some level has probably become a lot lesser in intensity compared to what it started off with. The third thing that we have to remember about conflicts and wars, etc., is that if they are not too prolonged, especially, if they don't go on for a very long period of time, then the economic consequences do not tend to be very harmful. Wars become a problem for the markets only when you have situations where the war leads to significant drop in economic activity, significant suppression of growth, and which leads to then various other kinds of problems where your fiscal deficit for a country goes for a toss or your currency becomes very volatile. Those situations arise when the wars are too prolonged. But since generally that feature is not seen in the world at large, I think we do not have very prolonged impact on economic conditions. And so these are the 2-3 things that one has to remember about conflicts, about geopolitical issues. But they do keep coming once in a while. They will be irritants, they've been irritants in the past, they will be irritants in the future as well. So we have to live with it. That is something that we have to be ready for. Perhaps at times, if they induce a lot of volatility in the markets, it should even be used as an opportunity. And then in hindsight, we've always seen, whether it is trade wars or whether it is these kind of situations or any other events, they always tend to have become good opportunities in hindsight. When you look at the market situation, then 2 years later, 5 years later, you regret the fact that you did not act, promptly at that point in time when that event arose and when those conditions developed and when those opportunities came in front of you. So I think that needs to be remembered, and we should not, try to overlook that. I'm just underscoring this point a little more because we are right now, as we speak, passing through that such a scenario, and therefore, it might be handy for one to know about it. Uh, why do we say that we will now come back into this cycle is because of 3-4 reasons. Why should we expect that economy should accelerate? I think since the beginning of 2025, calendar year 25, after a somewhat slower 2024, uh, the Central Bank of India and the Government of India has acted very, very promptly, as I said. It started with the central bank actually taking in a lot of measures to induce liquidity in the system. Liquidity was a little constrained in 2024, but now that has become pretty decent. That is important from the point of view of ensuring that India can show that level of growth that it wants to. The second thing which has happened is that the Government of India has come back, for example, in the budget and thereafter, to communicate a point that they want to create the conditions for growth. So in the budget, we saw that they made an effort to revive consumption by giving certain tax breaks. They were also wanting to communicate the message that spending in the economy, public spending will continue to rise, maybe at a slower pace than in the past, but they are still committed to spending, whether it is in things like urban infrastructure or whether it is ports, airports, and several other things, where the government, railways, these are activities which they want to continue to invest in. So that was adequately confirmed in the budget as well. Immediately thereafter, once again, the central bank acted by reducing interest rates finally. What was a long wait all throughout 2024 finally happened in 2025. So we've already seen 2 rounds of rate cuts which have happened during this period. And last but not the least, we probably more recently also saw the weatherman come and say that we probably are looking forward to a good monsoon this year. So I think in many ways these are some of these levers which have once again started to have been put in the system. Their impact may not be seen immediately in the next 15 days or 3 months, perhaps over the next 2 or 3 quarters. But I expect that the slowdown which was happening in the economy through second half of 24 and early part of 25 is probably behind us. And as we see corporate earnings start to once again steadily grow, I believe that should add to confidence of the market. It may not be very clear or well asserted at this stage because we are going through this backdrop of trade wars and physical wars. But I think as soon as that part is behind us, earnings will be the final determinant of the markets. It has always been. As I said, it is always the economic growth which finally matters from a market standpoint. Events like these can create a problem only if they come to a situation where they are going to impact earnings growth and corporate growth and economic growth in a significant way. If that is not the case, then we should feel still reasonably confident that the recovery is more or less imminent. So I think that's what makes me pretty confident that we are going to see the market performance improve as we go ahead, especially as earnings recovery or earnings acceleration starts to begin. So that's as about the domestic macro side is concerned. From a global economic standpoint, as I said, even today we are seeing conditions, particularly around the US economy, which is the largest one, are reasonably decent. China, on the other hand, had a downdraft for the last 2-3 years, but it is starting to kind of improve even there. The complexion of the Chinese growth story is changing compared to what it has been in the past. It has been primarily been a country which has been dominated by, the driving factor out there has been investments and consumption. Today, it is an economy which is gradually metamorphosing. It is after DeepSeek, which has happened 3 months back. We've started to see that China has become a lot more important, country from the importance of technological developments. So it is at the forefront of technology, whether it be robotics, whether it be artificial intelligence, whether it be new forms of medicine, medical equipment, etc. These are the cutting edge. These are the new frontiers which China is targeting, and that is one of the reasons why it's the conflict with the US with regard to trade. Earlier, for many decades, China was on a different path, the United States was on a different path, and they were not colliding with each other. It's the first time that China and US are now at a stage where both are fighting for that same pie. They are fighting for technological dominance, technological supremacy, and that is the reason why these clashes or these trade wars have started to become a lot more prominent. But having said that, China may be slower in terms of growth, but the nature of its economy is changing, and probably even that at this stage is looking to be gradually rectifying some of the problems it has had in the past. Trade wars will lead to a situation in the near term where growth will get affected. We have to be prepared for that. Uh, uh, Even if tariffs are lower than what I said had been announced on 2nd of April, I think there will still be an impact. Tariffs will be significantly lower compared to what the headline tariffs Trump announced on April 2. After that, we've in any case seen a lot of backtracking and a lot of rollbacks, so to speak. But even if it were to end up being, say, anywhere between 10 and 15% in final trade tariffs versus the 25% which was announced on April 2, that 10 to 15% compared to about 5% which it was before April 2 is going to have an impact on the global economy and global trade. Luckily, India is, from that standpoint, not significantly exposed. Our global trade is less than 15% of our total economy. Our trade with the US is even lesser. Our total trade with the US is about $120 billion, $80 billion is exports and $40 billion is imports from the US on an economy which is currently trending at around $4.5 trillion. It is less than 1%. So to that extent, therefore, it is not as big an issue for India. There will be certain sectors which will get affected, and we'll talk a little bit about that as well. But at an aggregate level, India will be relatively less impacted. In fact, on a more longer term scale, we feel that there is a possibility that we might even be benefited because there will be certain areas where probably if some of the other countries around the world, whether it is Indonesia or Vietnam or Bangladesh and a few others, and even China for that matter, are more impacted, then from a relative standpoint, we will have an ability to increase market share, and especially in many segments, whether it be things like footwear, textiles, a good number of other things, a lot of small things like artifacts, umbrellas, and a lot of such stuff is basically where China dominates. It has 30-40% share of what gets imported into the US, whereas India's share is barely 1-3%. So that gap, that large gap at some level can get bridged, and that will be even an opportunity for India in certain sectors again, that is also something that we will see. So I think there are opportunities for India more than disadvantages at this stage, is what I would think from the perspective of trade wars. When we talk specifically about the markets at a headline level, as I said, I'm expecting earnings to recover. As earnings recover, that should probably lead to markets also starting to respond. In the last 2-3 quarters, we've been going through a phase of earnings downgrades. What matters in the markets is not the absolute level of earnings, but what is the direction of earnings which have been built into the expectations of the market, and what is the reality. In the last 2-3 quarters, the expectation has been going down. So earnings expectations are being revised downwards for the last 2-3 quarters. And that is why the markets have turned weak. As we go along, we expect that earnings should start gradually getting revised upward. So the expectation today, if it is 100, and over a period of time that 100 inches up to 101, 103, I think that is what will drive the markets. Whereas in the last 6 to 9 months, we've had a situation where expectation was 100, but the delivery was coming out to be 99, 98, 97. And that was something which was a cause of disappointment for the market. So I think that picture will start to reverse. Alongside which I also see from a global standpoint, flows into the Indian markets, FII flows, as we all know, also start to kind of, improve as we go along. There are two, three reasons for that. One particularly being that it coincides at a time when we are starting to see a possibility of slowdown as far as the US economy is concerned. They are going to be affected a lot more by the trade war. First, it is going to be a slowdown in growth and an inflation shock. So that is why what they will probably see is something what is called as stagflation. Stagflation is a scenario where you see lower growth and at the same time inflation goes up. Okay, that is normally not what one would expect from an economy. When growth slows, inflation should also ideally come down. But because of the tariffs, because of the import duties which they are going to be imposing, the cost of goods and services in the US is going to go up, and at the same time growth is also likely to slow down. This picture will change 6 months later, where growth remains subdued, but then inflation also finally comes down, because continuing slowdown in growth will bring down inflation eventually. And then after that, we'll have to see as to how things go. Maybe the central banks out there, the Fed, etc., will start doing quantitative easing. They will reduce interest rates, increase liquidity. All that will happen in the second phase. But in the meanwhile, therefore, because the US will go through that phase, investors will most likely move money to some extent from developed markets back to emerging markets. We've already started to see trends of that happen over the last a month or so, before which we had seen a significant amount of money flow out of India, because at that time US was looking very, very attractive. There was a new government. The Trump administration wanted to cut taxes out there, personal taxes as well as corporate taxes, and do a few other things. So there was a lot of excitement which built up around the US markets, and money flew out of India into and emerging markets into the US. Now we see that trend to reverse, as the problems for the United States at the margin look to be higher compared to what we have today for our, in fact, our growth, as I said, is likely to accelerate, whereas in the US, the growth is probably likely to slow down at the margin. So what this is going to lead to is also investors' money moving from developed market regions, particularly the US, into emerging markets. The only difference this time around will be that when big funds flow happen towards India or to emerging markets, in this round, I think China will also be an important contender for those flows. Up until now, we have not seen China's equity markets do very well for one reason or the other. Last 2-3 years, it has been on account of a very weak consumption cycle out there, a very weak real estate cycle. Chinese households have a lot more invested in real estate than in any other country around the world. So a slump in the real estate market out there tends to impact them significantly. Consumption also, as a result of that, has slowed down. And more importantly, the Chinese government, unlike what it typically does, it has not stimulated the economy. It usually does a lot of pumping of money in order to stimulate. It happened, the biggest stimulus happened in China in 2008-9 when the global financial crisis hit all of us. China was the country which actually stimulated its economy the most. But then after that, in the last many years, they've not resorted, even during COVID, they did not resort to a very strong stimulus. So I think Chinese markets have generally lagged in terms of equity participation. Foreign investors have usually preferred India to China in equity market investments because of various reasons, because of the stability of the country, democratic processes, legal, a relatively more cleaner legal system, etc., etc. But this time around, I think China will probably also be an equal contender, and that's thanks to the change in the complexion of the economy, which I said is happening. investors now do not want to look at China only from the point of view of it being a large consumer market or a country which is doing significant amount of investments in infrastructure and so on and has a deep investment cycle, strong investment agenda. That's not the only thing. Today, Chinese companies are looked up from the point of view of their technical skills. They're trying to now be very relevant as far as many new domains are concerned. Electric vehicles, for example, BYD competing with Tesla and so on and so forth, and the kind of work that they're doing in new gen battery systems, as I said, advanced medical devices, robotics, artificial intelligence. So I think the nature of the companies out there is dramatically changing, and that is what is going to attract foreign investors. Today, India, unfortunately, is not able to provide an avenue for investments in those areas. Yes, we are very strong in our traditional IT services, but not in areas of cutting edge technology. So I think that will be the difference. But yet we will get a share of our investments, our share of money, and that should also be supportive as far as equity markets is concerned. So net, I see over the next 12 to 24 months, not only the economic cycle once again gathering strength, I also see the market cycle once again improving as we go along. Maybe we will also see some re-rating of the Indian markets as we go ahead, especially after some of these other challenges are behind us. So I think we are in a good space. The only thing from an investor standpoint that we have to make sure is to ensure that we keep our course, we keep to that discipline, we keep to that longer term approach, and more importantly at this stage, also temper our return expectations. We've seen very strong returns for all of us in various asset classes, whether it is mid-cap funds, small-cap funds, thematic strategies, etc. All have done well. We've had very strong return profiles since COVID. Obviously, we cannot expect to grow at or deliver returns of the tune of 25% or more, as a CAGR for a long period of time. Those expectations need to probably moderate down to more like 15%. But I think that is still also a very healthy return. And even then, that it does not necessarily mean that it will only be 15% every year from now. There may be years when we might do significantly better than that as well, maybe even cross 20. There will be certain strategies which will probably allow you more than 15%. Certain strategies which are, if somebody is willing to take a little bit of risk, whether it is in small cap strategies or mid cap strategies, certain focus strategies. These are ways in which you can probably, even increase your level of return from that 13 to 15% mark. Perhaps it will, as I said, entail a little more risk, but it will still mean higher return. So I think that is how I expect things to unfold. Net, I think I'm generally constructive on the markets. I would think it is a time when such volatilities, if you get day-to-day volatilities, one should take advantage of. This is a time when your equity allocations, if they are not in place or if they are not at an optimum level, you should try and restore that back to some level of to that optimal level. And this period of volatility perhaps may last for the next few months. That is a time you have to make your product choices, make your investments, and put them in place for eventually things to compound as we get into calendar year 26 and beyond. So this is broadly a summary of what I wanted to say, but we'll quickly see a few slides just to make some of these points which I mentioned a little more clear to all of you. So let's start with the global markets and where we are in terms of the global play. As I said, the economic surprise index. So this is one way to look at what is the underlying expectations of the global economy and how things are unfolding out there. So as far as US and China are concerned, the two large economies around the world, things are quite okay, somewhat slow, but it is still not too bad. In fact, Europe is now starting to actually show some acceleration. We are, as I said, looking forward to some impact after the trade wars or the trade tariff related agenda is decided, we will probably get to know in the next 2-3 months as to where we are in terms of clarity here. When we look at, this is another way to look at the global scenario. So these are what are known as purchasing manager indices. These are a way to understand it's like a thermometer to gauge the health of an economy on a month-on-month basis. So this is what it has been over the last maybe 12 odd months. And red indicates that there is a certain amount of slowing down, and as we get to green, it basically means that it is in a accelerating mode or a healthy mode. So anything above 50 is typically considered to be good. Below 50 is generally indicative of a slowdown. So when you look at PMIs, there is a manufacturing PMI and a services PMI, but it is, if you look at even in the US, for example, the services PMIs are doing quite okay. It is a manufacturing PMIs which have been in a problem, but even there too, we are now starting to see the reds actually start to become a little yellowish. So it is still quite stable. Many countries around the world are still in the yellow zone, so it's not a very difficult proposition. India, both on the manufacturing side as well as on the services side, has been pretty stable. We saw some slowdown. So we were as high as 60, and that has come down to about 58, 59. So this was the situation in the second half of last year. But then things have once again started to pick up. Same is the case even in manufacturing. So 56, 57 is now starting to look up once again. And as I said, we have put some of these factors into place: low interest rates, liquidity, public spending now from the government, tax cuts, perhaps a good monsoon, hopefully if God is kind. If all that were to probably happen, then we will start to see some further acceleration in these numbers. Again, there's another way to look at it. So labor market is also quite strong. We probably look at consumer spending in the global context. Again, that is also weak to some extent, but still numbers are still holding up above that 50 mark, which is considered to be pretty okay. More importantly, I think when you look at inflation, so inflation has been coming down across the world. You look at the current inflation versus the 6 month versus the last 1 year, in every country, inflation has started to kind of come down compared to what it was earlier. And so is the case with India also. Now what was more like 5% inflation, 4.7 is now down to, the latest reading is now down to 3.3. So this is something which is within RBI's comfort zone, and it should essentially mean that we should be able to further have some interest rate cuts. We've already seen 50 basis points. If it becomes 100 basis points is what we expect, another 50 basis points. It will help consumers also, it will help home loans, it will help other types of consumer lending. Even corporates will be inclined to spend because they have been holding back for various reasons. Now the cost of capital is going down, so even their ability to announce new projects, employment, etc., all should start improving in a low interest rate environment. This is what has happened to rate cuts. So every country has actually, developed markets, emerging markets, has seen rate cuts. Well, of course, a quick word on the currency. The US dollar has been very strong, but this is also something which has not been to their liking. In fact, they want a weaker dollar at some level, because that has, in fact, that is one of the reasons why they have tried to do these trade negotiations, because they feel that, dollar has become the default currency, and whenever there is a issue around the world, everybody hides behind the dollar. And that increases the relative value of the dollar, and in the process makes the US exports less competitive. So they do not want that situation to continue for a long period of time, for now or henceforth. They want the dollar to, in fact, weaken a little bit. But in the very short term, the dollar has strengthened. Now, but in the last 1 month or so, after the announcement of the tariffs, the first round of tariffs, etc., on April 2, the dollar has significantly weakened, about 5 to 6%. And therefore, as you have seen, the Indian currency is also appreciated from more like 87, 88 to 85, 86. So I think currencies around the world have started to once again appreciate, but this has been the situation that throughout dollar has been a little strong. Let's look at the domestic again quickly. We have seen most of our economic indicators quite okay. The one key difference which is now emerging compared to the last 2-3 years is that, so after COVID, we saw a situation where urban growth was always very strong. But rural growth was lagging. Uh, Rural was a lot more hit on account of COVID. Urban incomes, urban employment, urban jobs were not as much affected. We saw a lot of migration, if you remember, during COVID, displacement of workers, etc. They had to go back to agriculture as an activity. So in a way, their incomes actually started to be affected. Plus, there were medical expenses and so on and so forth. So as a result of which, their ability to spend, discretionary spending went down. This has continued for the last 2-3 years. Whereas on the other side, urban growth has not been affected. Urban growth has been pretty strong and has, because many urban centers did not see a lot of job losses, income losses were not there. In fact, we saved money because we didn't travel as much during COVID and so on. So our ability to spend on other things actually increased. Now what we are starting to see in the last 1 quarter or so, it's very early, but in the last 3 to 4 months, 6 months maybe at best, we have started to see that rural growth is starting to pick up, whereas urban growth is slowing. It is not negative, but it had very high growth, so it has become a little slower, but rural growth has started to pick up. That at some level does influence our stock selection, and when we select companies in our portfolio, so we are using these indicators to decide as to which type of companies are probably likely to do better in the maybe near term, medium term, versus some of the others which have in any case done very well. So high-end consumption, whether it was about, high-end jewelry and premium cars and so on and so forth, that did very well. Today, perhaps it is the chance of, let's say, value retail, value products in the market, value discretionary products also, but at the lower end of the income spectrum. Those in our view might probably have a better chance, better growth in the coming 18 to 24 months compared to the other side. And that also has another 2 factors which will help it. One is, as we saw, interest rates coming down. When interest rates come down, then the bigger beneficiary are the rural households or the low income households, because they are more leveraged to interest rates falling or rising. Okay. So as interest rates come down and inflation comes down, their discretionary spends go up. Their ability to save goes up, and therefore their spending goes up further. Okay. So that is something which will help. And plus the other factor which is starting to look favorable is the monsoon. If that also were to happen, then on a combined basis, this will lead to a better growth in the rural markets. So this is what we probably should expect to see. We'll skip this. Inflation, as I talked about, is coming down and helped, thankfully, by lower food inflation. So that is something that we have to remember, and once again, as we see monsoons, if again that comes out to be well, then food inflation should remain subdued for a longer period of time. Now this is something which I was just discussing with a few of the people here in the room just before I walked in. So I think India has kept to this fiscal path, as we know. So basically, in any economy, there are always 4 components. There is the government, there is the corporates, there are the banks, and the households. These are 4 features which you can find in any country in every part of the world, right? And each of these has their own balance sheet. The government has its own balance sheet, corporates have their own balance sheet, banks have their own balance sheet, and households also, all of us have our own balance sheets. At a very high level, why do we feel that India is in today's times is in a good economic environment and in a good economic cycle? Is because of the fact that when you look at the balance sheets of each of these 4 constituents, each of the constituents have a reasonably healthy balance sheet today. And by a healthy balance sheet, I mean that we do not have a lot of debt. Many of you may have read, and we all know that the biggest problem at various levels happens when you get into a debt trap, or when your debt levels significantly run high, whether it is at the household level or the government level or the banks or corporates. Even at the country level. So now many of you must be reading that US debt levels have gone up significantly, which is the case, which is a problem for them. In fact, that is one of the reasons also behind this whole trade, the tariff war which is going out of the tariff, issue which the US wants to rectify. So debt is a severe problem. Today, fortunately in India, all these four constituents are at a stage where our debt levels are significantly low. Our leverage is very low. Government of India has been significantly reducing its fiscal deficit. So as you can see on the left, so even there the debt levels are reducing. That is also the reason why we are able to cut interest rates. And when you look at banks, then even our banks they have sacrificed a little bit of growth, but they have strengthened their balance sheets, especially over the last 6-7 years. They've reduced their NPA levels, they've increased their capital, they have generally made themselves a lot more comfortable to be able to survive under any kind of scenario. Okay. When you look at corporates, even corporates have significantly deleveraged, particularly after COVID. Everybody has been repaying their debt, increasing their cash balance, raising money from the market through equity, but they do not want to go and borrow a lot from banks. Households in India, debt levels have somewhat gone up, but it is still substantially lower when you look at comparisons to other countries, especially even other emerging market economies, Vietnam, Indonesia, Korea. All these companies are running at household debt, which is almost 70, 80, 90, 100% of GDP. Okay, whereas in our case, it has gone up from 5-6% to about 9-10%. It has gone up for sure, but it is not anywhere close to the type which is. So point being that when your balance sheets are safe, you do not have excessive leverage, then that is a very good starting point as a foundation for any economy. Because on that you can, even if you have a cyclicality in the P&L, your profit and loss account may probably go through cycles. But if your balance sheet is stable, you will be able to weather all kinds of storms. So it is important to keep a watch on the balance sheet. Even when you're analyzing, we do a simple thing like analyzing companies for investments. The first thing that we check is what is the balance sheet strength? And if the company wants to grow, what will happen to its balance sheet? Will it get significantly leveraged? Will it need a lot of capital to grow? Will it take on debt? Or will it have funds and surplus out of its own operations to be able to fund its growth? That is the primary question you should ask when you are making even your own personal investments in companies. And if you are doing a little bit of your own due diligence, please first go and check the balance sheets of the companies and not get carried away only by the fact that, oh, it's going to grow 30% and its profits are going to double and so on. That's secondary. That is also important. But how is it going to achieve that? It's in there comes the balance sheet, because ultimately whatever you want to do, whatever the corporate wants to achieve will have to be achieved on the strength of a balance sheet, right? So I think that's the good point for India, part for India today, that we are at a stage where all our important constituents, none of them are excessively leveraged. And that is why even from the perspective of things like wars, etc., our ability to probably fund our defense expense, let's assume that this scenario that we are going through prolongs for a lot more time. I think the conviction that the market is taking today is in the fact that we are not in a stage where our banks are in trouble or our government is in trouble, which has been the case at various points in time. Something or the other had gone wrong. But today we are not in that situation, and that gives us that additional comfort that India should be, and markets even are able to right now, what we are seeing in front of us, that we are in such a scenario, markets could have easily lost 10-15%, but that has not been the case. We are starting to see, as I said, this is about those 2-3 factors. Liquidity is starting to move up, credit growth is starting to revive again. RBI had also constrained a lot of things, so RBI had put in a lot of cover, restrictions in lending last year. Now they are gradually lifting that. So that is also helping growth. When you look at a reserves position, etc., all that is also quite comfortable. So even if we were to see a slowdown in growth, even if we were to see our import levels rise, our foreign exchange position and our monthly export-import ratio is quite balanced. In fact, there's an important thing to see. So if you look at this, which is basically we all know that we are a very heavy importer of oil. We don't produce our own oil, right? This dark blue line is basically about our net petroleum imports. And the light blue bar is basically about our services exports. And mainly here we have IT services as an important element. If you see in the last 4-5 years from FY21 onwards, we see that our services exports have become much larger than our net imports on petroleum. So our services have become so large that now we can easily fund our oil requirements. And in fact, our oil requirements are not rising as much because now gradually things are becoming more and more electric. Our intensity of oil usage in the economy has come down. Productivity of oil use has become better. So oil in any case requirements, petroleum requirements are coming down, whereas the service exports are going up. So even if oil prices were to go up significantly, we'll be in a good position. In fact, today we are in a better position because oil is also actually coming down. So that's another factor which is helping India from the point of view of inflation, etc. But this is also going to further help in the process from a longer term perspective. And when you look at overall flows, this is just a picture on flows. So more recently, foreign inflows, we have seen inflows in the debt market actually have been very strong because we have not issued as much of government paper, our 10-year yields have been coming down, etc. So FPI flows in the debt market in any case have been rising. But when you look at foreign inflows in the equity market, we have seen a big drag. However, in this also, as I said, from the last 1 month or so, we started to see flows reverse. And what was a heavy negative, because I told you that flows were going from emerging markets to developed markets. Now they have started to once again come back to emerging markets like India. So that's one. And last but not the least, just to once again maybe summarize, when you look at domestic factors, India, we know it's one of the fastest growing economies in the world. In fact, among the top 2 or 3 countries in the world, growing at a rate of 6% odd. And we have become the 4th largest economy in the world, and we are at a stone's throw away from becoming the 3rd largest economy in the world as well. So I think that is something which remains our biggest strength. Tariffs unlikely to hurt us as much, quite manageable. We have had some headwinds, but we are now starting to see improvement in the economy because of several factors. Inflation coming down, but government is wanting to spend, and expectations of earnings has been going down recently, but now it may probably start to reverse. And if that reverses, then the market should hopefully start to do better. Global economy stable for now, but will go through some headwinds on account of tariffs. India should be relatively less hurt. In fact, there should be an opportunity also for India from a longer term standpoint. Geopolitics will remain volatile. We have to deal with it. But as I said, if it is not something which is very long drawn, and if the economy starting point is strong, I don't think we should, from an investment standpoint, we should not think of it negatively. We should think of it positively, that if markets were to come down because of such situations, we should, as more disciplined investors, use that to our advantage. Recommendation, therefore, we continue to believe that India is in a good growth cycle. We have been of this view for the last 2-3 years since COVID happened, after COVID, because on the strength of that one main factor that all our 4 constituents are deleveraged. So that is a very good starting point. Our ability to withstand shocks, whether it is trade wars or other things, or temporary slowdowns, is much better. And therefore, we continue to back, and the government is pro-cyclical, the government is growth oriented now. So I think that makes sense. In such a scenario, it makes sense to therefore be constructive on equities, use drawdowns which happen in the market. It happened 2 months back on even account of the trade wars, and then we saw a very quick bounce back. At that time too, there were a lot of apprehensions. Nifty levels were more like 22,000 at that point in time. And we've reverted back almost 8-10% since then. So always use some of these big drawdowns which happen in the market to your advantage. That will 3 years later, 5 years later will make a lot of difference to your overall returns. Instead of your 15% compounding, your compounding will probably look like 18 or 20%. So don't fear the markets. If they are coming down, use that to your advantage. Do disciplined investing, and I think that should clearly work out well. This is what basically it is. I think we have a lot of stuff, but I think I'll stop here in the interest of time. I'll explain a few things if need be when we look at when we have some Q&A, and probably if you have anything that you bring up, and I will try and refer to some of these things. But this is how I would probably, summarize the state of play today. Thank you very much for a patient listening. We can probably open it up for Q&A. And
I request everyone to look into the files. You all have the Q&A slips in there. So you can write the questions and send, give the slips to the RMs near you.
Thank you so much, sir. It was very wonderful and insightful for us and for all the audience sitting over here. We have already started getting a couple of questions. If I can read out, Dr. Shankar Subramaniam has written, are you sure about more risk, more returns? My take, more risk is more risk. Over a very long period of 20 years, kindly give your perspective for the same.
can you just repeat the question once again? I'm not clear about
More risk means more returns.
I think we have to understand that there is a difference between risk and volatility. Okay, risk is when you do not cover for things which can probably go wrong. So if you have not accounted for what happens if ABC does not happen or XYZ happens, that is what risk is all about. The daily change in prices and volatility of indices is not exactly risk. That is more volatility. Okay, so we have to be clear about that. And therefore, usually it's not required that higher returns have to come with higher risk. Higher returns can also come by taking moderate risk, if not low risk. Provided you have understood those businesses well, and you have ensured that at a portfolio level you have managed that risk, that suppose if something goes wrong in one company, it will be counterbalanced by something else in some other company. That is a way to manage the risk. The risk has to be managed by making sure that you invest in the right businesses or in businesses which have got decent quality. I'm not necessarily saying only AAA. Everything is not AAA, and if you go for only safety, then you're not probably likely to make any return. But moderate risk can also lead to reasonably handsome returns. When you talk about very high risk, you're talking about buying into businesses where you don't have a lot of confidence, and they may disappoint you significantly. Or they may also surprise you very positively. So in such a situation, your probability of winning comes down. So I would say that instead of being high risk, high return mode, it is better to be in moderate risk, high return mode. And not be too defensive either, because we are in an economy which is growth oriented. It is one of the largest economies in the world. It has got the largest market in the world today, largest unexplored market in the world today, so to speak. So we should be taking some risk, okay, but not of the type which leads to a scenario where you incur fatal losses. That is what has to be avoided. But a certain decent level of risk has to be taken or configured in the portfolio, which is what is left to managers like us. So when we are trying to construct portfolios, we are cognizant of risk. That is why I said that the first thing that we do is not look at the P&L opportunity or the growth opportunity. What do we look at? We look at the balance sheets. Because that, agar risk aata hai, to it comes from there. You see all the problems in the world. 2008, 2009, global financial crisis was not because of anything else, but banks went for a toss, banks' balance sheets went for a toss, and it led to domino effects around the world. where balance sheets of governments and balance sheets of big banks, etc., became impaired. When we went through our own mini crisis in 2013, 14, 15, it was because our banks were not strong, or they were running through a lot of these NPA problems due to reckless lending to large corporates, and those loans were not eventually recovered and had to be written off. Okay, 2017, 18, we went through a financial crisis, mini financial crisis once again in the non-banking financial sector because of IL&FS. Again, a balance sheet problem where indiscriminate lending at ILFS actually led to that enterprise going down, and when it went down, it took other enterprises along with it also down. So crises along the in the world, generally the ones which are the most severe ones, which last for a decade or more, those are typically balance sheet related. P&L crisis do not last for more than 2-3 years. They are cyclical in nature. Okay, 2-3 years you will have slower growth, 1 year you will have slow growth, few quarters you will have slow growth, it will revert back. That's manageable. But a balance sheet crisis is something which takes a lot more longer to repair. So when we are constructing portfolios, we are cognizant of managing risk from that standpoint. Not risk ke bhai kal up circuit lagega, parso down circuit lagega, that is not risk. That is the general volatility of the market. Risk will come when you have invested in not so good businesses, or where the balance sheet or that risk or that ability for the enterprise to survive itself is compromised.
Right, sir. Thank you so much. Mr. Murjani is asking, fund managers do advise to invest in debt funds when equity market is in downturn. It is noted that during downturn, yields of debt funds also reduces with respect to bank FDs. What is your advice?
So today we are in a situation which is, so your proposition is right that, you know, generally when equity markets are not expected to do well because of maybe growth factors or inflation factors, people do turn defensive, and, you know, fixed income does become an avenue. But today we are in a somewhat different situation where we think not only are the equity markets prime for decent returns, but we also believe that our fixed income markets are in reasonably good shape, and the fixed income returns also can be reasonably good. And that comes from that conviction that, so if you look at the fixed income markets, we are going through a phase where rates are likely to come down, they're coming down, and they're further likely to come down. Inflation is likely to remain subdued. But our yields, which are there in many of the fixed income funds today, okay, they are quite high. You still are getting YTMs which are in the vicinity of around 7%. Your 10-year has already come down to 6.2, 6.3. Okay, or yields are, your YTMs are still quite high. Interest rates are likely to go down. When you look at it from the perspective of demand supply, today, Government of India, because it is not, it's reducing its fiscal deficit, it is not required to issue more government paper. So the supply of government paper is less. On the other hand, demand for government paper is rising. Why? Because India is getting included in major indices, foreign indices, MSCI and so on and so forth, right? JP Morgan, etc., etc. So demand from foreigners for Indian government paper is rising, but Government of India is not supplying as much of paper because it is controlling its fiscal deficit compared to the past. So demand is rising, supply is not rising as much, and therefore the price of that paper is likely to rise, or essentially the yields are likely to fall at some stage. So therefore that is also likely to lead to capital appreciation as far as fixed income is also concerned. So we are in that unique situation today from an economic standpoint where we look pretty strong, at least from a medium-term standpoint over the next 12-18 months, both on the equity side as well as on the fixed income side. I would advise investors to look at even fixed income instruments from a positive standpoint in their overall asset mix. One thing which I did not talk a lot about, but since this question came up, when you're looking at fixed income, equity, etc., I think the The one asset class which probably to my mind will become more and more relevant is something like multi-asset funds. Multi-asset funds which invest across a spectrum of avenues, whether it is equity, fixed income, international equities, domestic equities, gold, silver. I think those will become a lot more relevant, lot more central. Gold and silver too as commodities, as precious commodities, precious metals will become very relevant. They will have to be given a lot more important attention. Yes, we are all households which own a fair degree of gold historically, etc. But gold as an asset class will gain more and more strength, in my view. It might have small short-term ups and downs, but by and large, the trajectory of gold over the next 2 years, even after this massive rise in gold prices, to me looks likely to continue. So a well-configured multi-asset fund, which gives good importance to international equities, domestic equities, gold, etc., should also form part of your overall investment basket.
So next question is from Mr. Chandrasekhar Mutaya. Markets are down. War is in some parts of the world. What is the status of mutual funds? Should we stay invested in mutual fund? What will be the growth cycle for the next 2 to 3 years?
So like as I said throughout the call that, throughout the session that there are some of these distractions which are around. There is war, there are other conflicts, there is a changing, global trade configuration which is likely to happen over the next 5 to 10 years. The way trade has been up until now, global trade has been up until now, is not going to be the same. Different global blocks will emerge. There will be a block which will center around the United States in terms of trade. There will be a block which will center around China as in terms of trade. Countries will try to decide as to whether they want to be aligned to which one of them, or one over the other, or perhaps both. India will also have to take its own decision in that regard as to whether it wants to align only to the US trade cycle or trade ecosystem, or it also wants to ensure that it is part of the China trade ecosystem. So these two countries around the world are going to lead that trade configuration versus, let's say, it was only US led or the Western world led up until now. So I think there are going to be some of these things which are going to change. But in India, from an Indian market standpoint and Indian domestic economy standpoint, as I called out, we are in good shape. We still have a lot of levers to growth. Even cyclically, in a short period of time, over a short period of time, last few months have not been as good for us. We have slowed down in terms of growth, but government and RBI has been very quick in order to put in measures in order to ensure that growth is restored back to a better level. That should start reflecting in the earnings of the corporates. Market has already reduced its expectations about the ability of corporates to grow earnings. This is a good sign. When the expectations are low and positive surprise comes, markets will do better and your returns will be higher. Unlike a scenario where a lot of expectations are built and then there is a disappointment. Okay, that's pretty simple and clear to understand. So I think we are in that phase where expectations are low, but there are triggers and levers which can lead to an improvement, and that will be the positive surprise. If that positive surprise comes through, markets will deliver you the returns. So I'm of the view, I'm willing to take the view that some of these levers will start to assert themselves over the next few quarters, accelerate growth, and turn out to be therefore beating market expectations which are there today. Some of these other distractions, as I explained, do not last forever. They, in hindsight, always turn out to be good opportunities. So I think this is the time, if you're getting such a time, such a period when there is fear to some extent in the markets, there is volatility, there is anxiety, take advantage of that. That is the time you put your money in, you invest. Then be a little more patient, keep return expectations low, and then see how the magic unfolds.
Next question is from Mr. Brijesh. Which sector will outperform Nifty in the coming 10 years?
Okay. Well, 10 years is a very long time. You know what happens is that then you get diffused, and 10 saal ke baad, I don't know whether I'll be around, you will be, and we will not be able to even exchange notes to come back to say, 2025 mein we are we had said something like this. And so I think let's think 2-3 years or 2 years probably at a time. We don't want to be very so long-term oriented that we are not able to reconcile. There is a world which is changing dramatically, so obviously we have to, 10 years is a very long period of time in that regard. But I think over the next some time, we would like to think that especially where India is in its economic cycle and what it wants to achieve, areas like banks, industrials, the harder parts of the economy will probably do much better compared to, let's say, consumption. Not to say that consumption will not do well, but relatively, if you ask me, these are two areas which probably will have a larger role to play. India has always been known for its consumption opportunity and the fact that it is a very large and deep market for consumers. That is always well known, and over the last 15-20 years, consumption always been the mainstay, whether it is FMCG or whether it is consumer discretionary, autos, etc. All that has always been the, but in the last since the last 2-3 years after COVID, India wants to rapidly industrialize, keeping in mind the changing, complexion of the world as well. There are opportunities now with the trade war. As I was trying to show this thing, something like tariffs actually can play in to the advantage of India. Look at India's positioning, versus in terms of rates as well as in terms of the exposure that we have. Our exposure is very low in terms of exports to the United States, and our tariffs are probably one of the lowest compared to some of the other regions. So this can bring a big opportunity in the areas of whether it is clothing, footwear, chemicals, etc., etc. So there are some of these areas which can really benefit as far as the Indian economy is concerned. And at our end, our government itself is wanting to ensure that there is a certain level of public spending, whether it is in, as I called out, areas like urban infrastructure, metro work. We can see that around us, airports. We have doubled the number of airports in the last 10 years or so. From 70 operational airports, we've gone to 154. Okay, 154 probably it's forecast to become 250 to 300 airports. We've got two big, large new airports which are coming up, whether it is Noida or Delhi, and that is Noida and Mumbai, and which is going to basically, accelerate air traffic. So ports, railways, we are seeing the modernization as far as railways is happening, the Vande Bharats and the bullet trains, etc. So I think a lot of money has got to go into industrialization. Power sector itself, again, as part of the industrial world, again, something which we like a lot. We have a fair bit of exposure to that in our portfolio. Power demand is rising, but more importantly, the nature of power is changing. 5 years from now, we are going to have at least 30% of our overall electricity consumption coming out of renewables, whether it is solar, wind, nuclear, and so on, compared to traditional coal-based. And that means a spectrum of opportunities in the power sector, whether it be in transmission or whether it even be in distribution. So I think many of these areas are something which is not what India has been known for. India, as I said, known for consumption, but not as known for industrialization. And that is where the surprise might be. So I think that is where I would expect growth to be relatively more superior. Consumption also will grow. There are several things in discretionary consumption can also help. IT services, I think, will be a function of global circumstances, but we will have to live with a relatively slower period of growth in IT services compared to what traditionally it has been. We have grown at times even at 30-40%, and then we've grown at 15-20%. But now we have to reconcile ourselves to more like an 8-10% growth. So it will be a good, still a decent growth. It is still a very large sector from an employment standpoint and consumption standpoint. I think that is something which will continue. But in terms of growth rate, I think industrials, infrastructure-related businesses will probably have a faster growth rate. We are very positive about the real estate cycle. Real estate also is a cycle which has very long cycles, in the sense that the down cycle also lasts for 10-12 years, up cycle also goes on for 8-10 years, and so on.
today we are probably seeing an upcycle after a gap of almost 10, 12 years, okay? And that upcycle perhaps is just about 2 or 3 years old. It may have its small subcycle dips, but I think the larger trajectory of real estate is still got a decent distance to cover. So I'm pretty positive on real estate as another sector which we think does very well. And the other sector which should outperform over the next 2-3 years, area which should do well in our view, is pharmaceuticals. Pharmaceuticals and healthcare. Pharmaceuticals especially in some of the newer areas like biologics, etc., which is where some companies, mid-sized companies, are actually more dominant. So we have a few chosen companies which are there in our fact sheets and in our portfolios. You can have a look at them. They seem to be, in our view, well positioned to take advantage of that new opportunity which is coming up over the next few years. They can even grow at 25-30% CAGR over the next 3 to 4 years quite easily. So again, that is one area that we are very excited about. And in the domestic healthcare side, we are very excited about hospitals as an opportunity because hospitals are becoming larger and larger, more prominent. Hospital chains are consolidating. So they are buying out smaller hospitals, and from the perspective of the consumer, the patients, we are now willing to, because many of us are resorting to health insurance compared to in the past. I think we are willing to avail of better healthcare services instead of going to a nearby nursing home. We would probably prefer to be in a frontline hospital where we can get probably better healthcare. So that's also, from a demand side, it is driving that growth. And on the other hand, important hospital chains are emerging. So some of these things, strategically or most from a secular standpoint, look exciting to us. They can have a good few years of uninterrupted growth for us to benefit out of.
Thank you, sir. Next question is from Mr. Unni Krishnan Nair. Do you think investments in the US MF will be better returns than Indian MFs?
No, I think it will be exactly the other way. I feel there will be cycles, there will be points in time when one market will outperform the other. But now, considering where United States wants to go and the reorientation that they want to bring to their economy as well as to the world global economic order, I think they are going to encounter a period of slower growth in the near term. And so if you look at even the US market's recent performance over the last 3-4 years, we all know that it has been predicated on the growth, on the performance of these Magnificent Seven, Mag 7 as they call it. It is the Googles and the Facebooks and the Nvidias of the world which have actually driven a lot of the large part of the returns in the US markets. In India, on the other hand, the market performance has been a lot more broad-based. We have not seen our returns come out of just top 5 companies or top 7 companies. In fact, the mid-cap and the small-cap space, where there are hundreds of companies, have actually delivered much stronger returns than the narrower market of the top 50 or 75 or 100 companies of India. So I think our growth model, our return model, perhaps our market performance has been completely contrary to what it has been in the US. And I would like to think that at an aggregate level, if our earnings are probably going to grow faster than that in the US, then it's quite natural for our returns also to be better than that of the US.
So just an extension to that question, Ms. Nalini asking, if US goes into recession, what kind of impact it will have on Indian markets?
So as I said, that we expect that the impact will be relatively lesser. One is that so let's look at some of the slides here. First is that again that issue that we talked about in the previous question about the US growth. The US growth can also get stalled because of the fact that they've got this very high debt situation that they are in today. And that at some level can limit their growth. They may not be able to kind of extend their balance sheet beyond a particular point to be able to grow. They have done this during the years of COVID, etc. But and that has supported their growth, but it may not be easy to do so as you go forward. And the cost of servicing that debt is also constantly rising, and therefore that also needs to be controlled. Now, when you talk about India's situation, today we can see that India in the last 3-4 years, our exports to the US have risen. Our export surplus has risen, for sure. Okay, we have also now got one of the highest trade surplus with the US at 48, as I said, $48 billion. So it is there, it is rising, but we are still not as high as what it is in many of the other countries. It has gone up from maybe more like 25, 30 to 45, but the thing is that it is still one of the lowest in the world. So to that extent, it's not that it is a very large portion of our economy. $48 billion on an economy which is $4.5 trillion. So it's quite small from that standpoint. It is quite possible that we may be, in fact, at an advantage. In certain sectors, we might be actually be able to scale up our exports further. So that's also something which is a buffer for us as we go along. Our trade, from a tariff standpoint, from the rate standpoint, we are, however, at a disadvantage. We have one of the highest tariff differentials because we charge only 4-5% for our imports from the US, and we charge a lot more, whereas the US charges us only about 4-5%. So our tariff differential is very high, and therefore, so if you look at that pink line, this is where it is. We have a 6% differential. We charge them approximately 10, they charge us 4. So the differential is 6, which is the highest amongst other countries. So this has to come down, and which basically means that we have to offer them better rates, tariff rates on our imports from the US. We have to bring that down. That is something that India will have to work on. This is our disadvantage at this stage. We have to also understand that it can be done quite easily. There are 2-3 areas if we can make that concession for the US. Agri products, oil and gas, and to some extent defense products. These are very large baskets. Okay, value-wise they are pretty large. This $48 billion surplus that we have, we can reduce that by buying more defense items from them, by buying a little more oil and gas from them, and it will come into balance. It is not a big challenge to bridge. So all I'm trying to say is that our starting position is not too bad. Rates-wise, we are a little high. We have to bring this down, but it is also not something which we cannot manage. However, the important thing is, and then we are also doing all these FTA arrangements, FTA agreements that are being signed. We saw one with the UK being signed recently, and hopefully we should be doing this with the United States also very quickly. So that is another area through which we can probably cover some of the differential. And last but not the least, which I said, that in fact there might even be an opportunity on the other side. Because if some other countries end up with tariffs which are higher than ours, then in certain areas it will open up a market for us. Textiles, chemicals, footwear, even some engineering products. Our exports to the US is a very low share. And if our tariffs become lesser, for example, if we are at 25% and something else is at 35%, then our cost will be lesser. And that will give us an advantage in the US market. So more than the disadvantage, I think we have an opportunity in front of us. Although this opportunity is not something which will come quite easily, India will have to make some good amount of investments in infrastructure, etc., in order to capture that opportunity. And it will also take time. It will happen over a few years. But still, at a net level, I would say that we are in a happy position.
So the next question is from Ms. Reena Jana. China's inflation rate is quite less, but India is pretty high, relatively rate comparatively. How can this issue be addressed to have significant returns of investment?
So I think the good part is that in India too, the inflation levels are actually trending downwards. It is perhaps a little higher compared to let's say US or even China for that matter. But we also should remember that in the last few years when our inflation has been higher, our growth also has been higher. Even China's growth has slowed down quite materially. In fact, we are now growing at, even now we are growing at a rate which is higher than China. Whereas at one point in time, China was growing at 9%, we were growing at 6-7. Now when we are still growing at 6-7, China is growing at 4%, or 4 to 5, 4.5. Okay, so I think adjusted for that extra growth that we are getting, our inflation is not too bad. However, our inflation has also been trending down. I showed you the chart where our inflation levels across the world, it has come down, but then we are perhaps down to, let me see if I can find that slide. We have come down to 3.3%. Inflation has been falling around the world. So from what was, let's say, about 6% inflation at one point in time, we have come down to 3.3. Let's say at an aggregate level, we are still at 4. We are now in the comfort band. RBI's comfort band is 4 to 6%, as you know. So we are at the lower end of the comfort band, which is a good thing. So that should, I think, help over a period of time, and it is helping our currency as well. So now if you see the differential, US inflation versus our inflation, US inflation is also at 2.5-3%, and even ours is at 3.5%. The gap is narrowed down significantly. At one point in time, US inflation used to be 0.5% or less than 1%, and we used to be at 7% or 6%. Now, because of this very high differential, our currency was also depreciating every year by 3-4%. Now in the last some time, if you see 12-18 months, our currency is barely depreciated 2% or 1% versus the US dollar. So that is another advantage which is coming to us as a result of the differential between inflation of two countries narrowing down. China is a different example case. They have been slowing. Their inflation is somewhat managed at one level because they have also not been spending a lot, as I said. They have controlled their fiscal even more than India, but they have suffered as a result on account of their growth. So I think there is that differential which will, and for China, the food inflation does not tend to become a very big problem. For us, a larger part of our inflation problem has been because of food inflation. So I think that also is now settling down. Our food inflation is what is actually now coming down even more rapidly. So that hopefully should further narrow down the differential with China.
So the next question is, what is your outlook for gold and silver?
So as I mentioned, and I'll just elaborate a little bit on gold. So see, gold has got a few features, and it has got a certain current scenario which is becoming very critical. As the dollar is becoming a little bit of an issue, it is getting debased to some extent. The global trade wars which are in progress, the situation of US debt, all these things are, as I said, likely to slow down US growth. It is likely to lead to a situation of somewhat higher inflation in the US compared to the rest of the world. We have a scenario where there is a lot of geopolitical matters which are in action around different parts of the world, whether it be Russia, Ukraine, whether it be the Middle East, and now the Indian subcontinent. In such a scenario, gold's appeal will only go up as a hedge to inflation, hedge to all these other risk factors. Okay, I'm not saying that everyone is going to abandon gold. Gold is abandon dollar. The dollar is still, there's no alternative to the dollar still, but at the margin, there will be investors who would want to diversify their basket of holdings away from US dollar denominated assets to other assets, and in which gold has its own important prominence. As you know, gold production wise, so it's a commodity at the end of the day, but it is a precious metal. It has got its own characteristics. There is no other precious metal which has those kind of properties as gold has. Okay, it is the epitome as far as materials is concerned. Okay, and what happens below the core of the earth, what happens to gold is the epitome. There are 20 things which come together in order for gold to be formed in the crust of the earth. Out of that 20 things, if 2 do not happen, gold becomes copper. Again, another 2 things don't happen, it will become something else. It will become further debased. So you see, gold is something which cannot be replicated in any other way, and it is, it takes hundreds of years for it to form in the beneath the surface of the earth. So point is that the supply of gold is always limited. Every year you probably get about 350 tons of gold in fresh production. But the demand today is running at 350 tons of gold every quarter. But today the demand is running at 700 tons. So you have a break even of gold at 350. If 350 is the demand and 350 is the supply, then it's fine. But today, supply is at 350, demand is at 700 tons per quarter. And why has this happened? Because large part of this extra 350 tons, almost 30-40% of that is coming from the central banks around the world. Central banks of prominent countries like China, Russia, Saudi Arabia, Japan, all these countries over the last many years have actually only been buyers of US dollar assets, US treasury bills, because they never saw any issue with that. But now today we are coming to that phase where dollar is, at least there has to be some diversity which the world is seeking. Many of these central banks, they have reserves. Of that reserves today, most of these large countries which have a large dollar asset base. China, over the last many years, because it has been exporting so much, it has been receiving dollars, which they invest in treasury bills of the US. So in their reserves, their US treasury bills have been growing. And as a result of which, the gold as a composition is not even 5%. In case of India, India is probably one of the countries which has got double-digit share of gold in its reserves. So our reserves, if it is at $800 billion today, we've got 11-12% as gold reserves. But in countries like China, Russia, Saudi Arabia, which are large holders of dollar assets, their gold component is very small. And in the current situation, they are looking to make this go from 5% to 7% to 10% and so on. So at least for the next 2-3 years, if they keep trying to do this, that demand will remain at 700, maybe even go to 800, 850, and supply will only be at 350. Or maybe it will thoda improve, okay, maybe it will become 375 or 400. But yet there will be a big demand supply gap. So I think purely on the basis of demand supply, gold will continue to do well, very well in my view. I think we have to remember that a good part about gold is that it doesn't hurt anybody. If gold prices go up, everybody is happy. Okay. Unlike silver, because to some extent silver actually has a industrial application. So silver ka price बढ़ गया या oil ka price बढ़ गया, तो then it leads to other complications. Your petrol prices go up or whatever else, and inflation happens. But gold is not part of the inflation basket. It doesn't hurt anybody. Everybody feels good about it. It's a good wealth measure. It's a good safety. Traditionally, therefore, Indians have been very smart of having invested in gold. But now the reality is setting in. So I think it's a win-win situation. I think that's why I said that, either you have your gold allocation up on your own, or even let's say something like a multi-asset fund, which is well structured, such as to give you a good exposure to gold, silver, international equities. So you get a diversified basket. In fact, that is a better way to actually produce a diversified basket and minimize risk, rather than take a very large cap fund where you actually are just hiding and trying to be defensive, not getting any adequate return. I think if you want diversity, if you want to have safety, if you want to make sure that you're able to navigate some of these complex conditions which are developing around the world, I think multi-asset funds, well-structured multi-asset funds, well-designed multi-asset funds are a good way of achieving that same objective. So to be in a nutshell, gold is positive. Silver is more about the differential between gold and silver. Today, gold and silver differential has become very high. Gold has significantly outperformed, silver has not gone up as much. When the ratio of gold-silver reaches a certain extreme, then silver is a good buy. I would say that is the stage where we are right now. Silver also looks quite attractive to us, okay? But silver, we have to always remember, is an industrial commodity, and therefore some part of its growth will be linked to industrial demand, overall global growth, macroeconomic growth, etc., etc. So if there is a slowdown in the US, if there's a little bit of slowdown in the world, then that will have its implication on silver. But right now, in terms of value, it has reached an extreme. The gold prices have moved up significantly, silver has not. And therefore, that also makes, as of now, silver attractive, irrespective of whether growth will slow down or not.
So the next question is from Mr. Manjeet Sahu, which you have already mentioned. Which are the sectors where we as an individual investor should be looking at? Alternatively, where we should be focusing in the next 2 to 3 years, small, mid or large caps?
So I think the first part we've already answered. The second part about small mids, I would say that, look, as I said, we are pro-cyclical, we are positive. We believe that a lot of opportunities are coming about in the broader markets. A lot of businesses have become pretty, newer businesses and old businesses have come to a stage where they have become pretty attractive. Several different kinds of newer businesses opportunities are also coming, online, digital companies, new generation businesses. They are also emerging, keeping in mind the requirements of, the newer requirements of the market. So I think we are very positive on the broader mid-size and small-size companies. I would say to that extent that, when I look at between large and mid-caps, I think mid-caps are even better than large caps, I would say. See, why were we always buying large caps? The reason to buy large caps at various points in time in the past was for stability and for safety, okay? Today, if you go to see actually many of these mid-sized companies, which are, let's say, the 101st to 175th company in India by market cap. If you look at that segment, many of these companies out there, they have been around for now a good number of years. Many of these businesses have seen good number of business cycles. They've gone through ups and downs, and yet have done pretty well for themselves. Their managements have done quite well, and they have managed these cycles well. They have become franchises which are relevant and important. Some of them have also got some very good brands which they have been able to build. So I think, and most importantly, they are providing growth which is somewhat better than the large caps. They are still growing at rates which are better than system rate of growth. System rate of growth, by which I mean 10-11%, which is our nominal GDP growth. So I think you have now, mid caps have actually become the de facto large caps. They are giving you the stability of large caps, the reliability of large caps, and they are giving you growth characteristics which are better than that of the large caps. So I think that is why it is not surprising that right now when you see mid-cap valuations are at a premium to even large cap valuations and to small caps. They are the most expensive in the market today. And that's because of this, the credibility that they are developing. And then there is a demand supply situation also, which is also leading to the multiples being higher. So I would say preference-wise, mid-caps and small caps for sure. I see a lot of opportunity, and when domestic market is doing well, domestic economy is doing well, and domestic economy is expected to do well, mid caps and small cap companies will always do well, because mid cap and small cap companies are leveraged to the domestic market. Many of the large cap companies now have exposure to overseas markets, whether it is US or Europe or wherever. Okay, but most of the mid-sized small cap companies, they have a lesser percentage of exports or lesser percentage to international business. The larger part of their growth is derived out of the local markets. So if the local markets are expected to do well, mid-size, small-size companies will always do well, better than some of the large caps. And then within that, you have to make your choices and construct your portfolio. That's a secondary thing. But in my view, and the best chance for producing alpha at the end of the day. Safety, yes, maybe large caps perhaps might give you that defensiveness and safety, but your best chance of producing alpha and getting returns ahead of the market lies in selecting a good bunch of mid-sized, small-sized businesses of India.
So next question is from Ms. Anita Mehta. Your advice on best portfolio management in terms of equity, debt or hybrid?
Best portfolio
Management, yeah.
You mean, so I don't know whether I got the question right. Sorry, the person in the audience who. Is that the
Portfolio management
question?
services, yeah. PMS.
So just can you repeat about it?
Your advice on the percentage of portfolio management services in terms of equity, debt, or hybrid, or in the
Okay,
portfolio, you
okay,
can
so
say. In the
distribution
portfolio.
between these, equity, debt, and hybrid. So at this stage, I would say, well, equity followed by hybrid followed by fixed income. Equity should, in my view, at this stage of the market cycle, should be at least 50% of your allocation. Um, as I said, hybrids, and particularly within hybrids, something like multi-asset, even better than, let's say, some of the balance advantage funds, etc. I would say um, should at least now start forming about 20% of your total distribution. 15 to 20% should be in your multi-asset stroke hybrid funds, and the balance, what you're left with, is about 25 to 30% can be a mix of fixed income, essentially. So I think that is what you should be broadly. This would be my choice at this stage of the market cycle.
So Mr. Madhvendra Bhatia is also asking on a similar lines. He is a senior citizen for 75 years of age. What should be his allocation?
Well, I think you know, even for senior citizens, I would say, at least in those which are in the age bracket of 60 to 75 years, I think if you have covered yourself in terms of your other responsibilities, whether it be medical insurance, health insurance, etc., and a few other things for the family. I think what you're left with as a balance, you should have even those who are 75-year-olds in India actually are at a stage where they will hopefully see a very good 10, 15, 20 years of India's economic growth. So it's not still as late in the day, and therefore I would not shy away from saying that even they may want to have a reasonably high allocation, decently high allocation towards equities. Maybe select strategies which are somewhat moderate on risk or low on risk if they want to, or such that the returns are maybe not as high but still adequate enough. I would still say that the allocation by and large should be the same. If you can get to a 50% allocation, maybe if not 40 or thereabouts in equity should be fine, and you can move the same 25-30% into fixed income, and the balance in things like gold could be one asset class where senior citizens can probably have a high allocation at this stage, or choose multi-asset funds which probably have a high allocation to gold and silver. So that's maybe the differential that I would call out between a regular investor or a younger investor and a somewhat more senior investor.
So extension to the same thing, Sangeeta Lata is asking, at the age of 55, what should be the allocation for retirement?
Allocation I have not really thought of it from that standpoint, but I am perhaps more or less in that same age bracket, so I can say that the way I have planned for my retirement is essentially to make sure that you're well covered on, if you have kids, then you first cover for their expenses, and then followed by medical. That is another thing that you should have it well covered. And then after that, I think much of my allocations beyond the residence that I own is in equities. So I would still say, like I said, for even a 75-year-old, they still have a good 15-20 years. So the same goes for somebody of my age or somebody in that age bracket. He should have a material allocation to equities at this stage.
So in fact, there was a study in the middle which mentioned about age of 50, 55 is not supposed to be old. So actually you have a good number of years to go ahead. So you have to build your portfolio accordingly so that you last your money longer than the money lasts you.
Yeah, I think we've always seen that, equity compounding has always been one of the most ideal. Gold, of course, has matched up quite well. It has caught up significantly in the last few years, last 2-3 years. And as I said, gold is going to be on a tear for the next 2-3 years at least, till the time this elephant in the room is there, which is the central banks around the world who want to rectify their balance of gold in their reserves. That is going to go on for at least 2-3 years, and therefore there is quite a good possibility that gold in those 2-3 years also will return perhaps as much as what equities return, or perhaps a little better than that. It's just a plain simple demand and supply scenario, but that is how it is. I think, yeah, I mean, if you ask me, I've been, in my asset allocation, gold has started to become more important than what it traditionally was.
It's a little extension to the retirement thing. In order to get 50,000 per month, how much should be invested in SWP? What is the growth that we can expect after 10 years?
Okay, I have not done this math. Sorry, you'll have to excuse me on that. But we do a lot of exercises internally. I think we can probably share that data with you separately. That should not be a problem.
So generally, it's actually a good calculation to do over the number of years that you are willing to give to your investments. That can build up a corpus. So 0.5% of the corpus is good amount for you to take away as in terms of SWP. And that money with calculations of inflation put together and the withdrawal over the years will last you longer than, we have done this calculation for 40 years.
So Rahulji knows the answer, and he will make sure that he gives you that data. But I think we also do some calculations, and we put out the maths around it. We can help you with what we feel from our side in that regard.
There was another question on EPFO. Whether EPFO is better or your investing in mutual funds are better. Because there were a lot of government employees who had this question.
My experience,
recently.
I have been, even I have been an investor in EPFO because we also have our deductions, etc. For me, obviously, my equity returns have way outperformed the returns which you get in EPFOs, which will probably average about 8%. And I have not thought about the tax implications as far as EPFO is concerned. So at least what we've got in equity returns is net of tax returns have been much better than what it has been in EPFOs. But if you're a government employee, or even if you're a private sector employee, then you have certain basic minimum allocations which go through. I think, but now even there, some of the tax advantages are gradually getting limited. So, I think I would assume that for regular employees also, probably the share of EPFO will only keep coming down, especially when you are going to be a little more sensitive to your tax outflows.
So Mr. Uday Amre has been asked a question which always comes a lot of time to us also. There are thousands of mutual funds in the market. How to evaluate two MFs to arrive at, to invest in, sorry. So which is the best
That's
MF
a
to
great
invest?
question. I think if I were not in the mutual fund industry, I would have been outside. I would have thought of the same question. That how do I, not only are there 50 mutual funds, but there are, as I said, more than thousands of schemes, and there are so many replications and so on. So I think, I think at one level, either through your advisor or through yourself, you don't have a choice but to try and understand a little more deeply about one mutual fund versus the other. Try and understand, if you can, a little bit about how the fund manager or that strategy conducts itself. What is the process that they typically, the process that they typically follow? Is it very person dependent, or is it dependent on the process of an organization? That I think is very critical, because if the person changes, then you don't know, you will be left high and dry. You come on the basis of past returns based on that person being around and that individual. If that changes, then you don't know how the future will look. I don't think you should put a lot of importance only on past returns. Sometimes it might even, the larger importance should be placed on the process and the conduct, and what is the philosophy of that fund. If you can understand a little bit better about that, It may be a day's effort, but it might be worth it because your mutual fund investment you're going to continue for 3 years, 5 years, 10 years. This exercise of understanding and evaluating may take you a few days, but it might still be worth it. So I think it should not be very person centric. It should not necessarily be based on past returns because past returns are can be very misleading. Yes, please, you had a question. Fund size for distributors it matters because distributors obviously today the way the distribution fee structures etc are, you don't want to if fund sizes are too large, then distribution commissions are restricted. But if your fund sizes are not too large and they are somewhere mid-size funds, then two advantages. One is that distribution commissions are decent, better, but more importantly, ability to manage those funds is a lot easier. A fund size of 50-60,000 crores in a small cap fund will always find it a little difficult beyond a particular point compared to, let's say, a 5,000 or a 10,000 crore small cap or mid cap fund. In certain categories like large caps, maybe it does not matter as much, but in mid size and small size funds, in small cap funds and mid cap funds, sizes do matter. Flexi cap funds, definitely it does matter. I mean, surely it matters because your ability to move from large caps to mid caps to small caps, or vice versa, is much easier in a 5,000, 2,000, 4,000, 10,000 crore fund versus a 50, 60, 80,000. Because market cycles are not too long. If you have to move from large cap to mid cap or mid cap to small cap, which is what a flexi cap fund should do, if it is going to take 6 months, by which time half your opportunity is already lost, right? So if the fund size is very large, it is restrictive, definitely. Even in a mid cap, small cap fund also, size beyond a particular point does come in the way. It tends to create a problem both ways, in the rising market as well as in a falling market. So I think, so in fact that is why at Invesco we pride over the fact that we are at a stage where we are not too large, we are also not too small as to be irrelevant. And we are not so large that we cannot actually take advantage of the opportunity in the market and deliver returns which are somewhat better than that of our peers. Because our fund sizes are there. Our mid-cap, small-cap funds are like 6,000-7,000 crores. Our flexi-cap fund is about 2,500 crores, and so on. So the point is that our large and mid-cap fund is 6,000 crores. So we are at that stage, we are not the 100,000, 500, 1,500 types. We are also not the 20, 30,000 types. So we have that headroom to grow, and we probably can even, share that benefit with our distributors through distribution commissions, and also generate better alpha for the end investor.
So next question is from Mr. Pradeep. Starlink satellite internet is currently under scrutiny by the government. What will be its likely impact on the economy after its launch?
So Starlink, basically from what we have understood as of now is, while even it may come through, it may not be able to replace traditional, telecom networks. Especially when you're looking at dense regions, and you might probably be able to replace them or have a substitute for that in urban-centric areas. But in rural areas and in the more denser parts of the country, you may not be able to provide seamless services. So I think it is not, to my mind, a very big threat. At least from a technological standpoint, I think what we have as 4G, 5G services today is best in class in my view, and it comes at a cost which is we all know the cost that we pay for our internet connections and telephony. It is the cheapest in the world. So I don't think, both from the perspective of the level of service as well as from the point of view of cost, Starlink satellite services, etc., or even other satellite services will be able to match up.
So next question is from Mr. Sanjay Suri. What is your take on the new special investment fund category that mutual funds are going to go launching versus the AIF, from risk to reward perception for long-term investors? What should be a specific criteria before selecting the fund?
So we are still at early stages as far as fund selection is concerned, but clearly this is a new opportunity which even we are very excited about. We want to move into the SIF space as early as possible. We, at this stage, actually, Invesco does not have even an AIF. So I would say that if it comes to selecting between an AIF and the SIF, I think our endeavor would be to first launch SIF. AIF can for us wait actually. So SIF to my mind is an even better, bigger opportunity in my view. It will mean, it obviously will open up, it will be a substitute to PMS, of course, or PMS type of investors, because A, it is going to be high ticket. B, it is also going to be, offer you that additional ability to probably take higher risk if you want. Again, I'm saying there is not about high risk. This could be a fund which might have higher volatility, but if well configured, it need not necessarily have higher risk. However, given the fact that it is, it gives you that opportunity to hedge your exposures a lot more cleanly. This basically will be good from the overall market standpoint, because India traditionally has been a long only market, in the sense you only invest, you only buy and hold, buy and hold. Here, another set of investors will come through who will also be shorting the market or selling against certain or hedging their long exposures. So I think it will provide it will over a period of time therefore bring a newer set of investors, will deepen the market and probably also make our markets a lot more liquid, because against every buy there will probably also be a sell investor also who will be coming into place. So I think it is good from the point of view of longer term evolution of the market. This is the way most other developed equity markets around the world have also moved, from being pure long only markets to being a long plus short market. And I think that's the journey that even India will follow. So I think this is good news from an overall standpoint, from a market's depth standpoint, from the point of view of investors' options, particularly for those who want to probably take higher, are willing to take higher risk.
So next question is from Mr. Vishambar. Your views on PSU banks, and if specifically we can just throw some light on Canara Bank if possible.
So we don't have a holding in Canara Bank. I mean, we don't cover that amongst our PSU coverage, so I'll have to probably skip that. But in general, I think at this stage of the banking sector and the cycle, while we are positive on banks, we feel that the opportunity at this stage is somewhat better in private banks versus PSUs. Simply because usually in a rising rate cycle, PSUs are preferred, because it doesn't hurt them much in terms of margins, in terms of profit margins, because they have a better liability profile, they have better access to savings deposits and so on. So in a rising interest rate environment, they have low cost deposits to their advantage, which the private sector banks do not have as much of. When the reverse happens, when the cycle starts to, interest rate cycle starts to go down, then that starts to actually at the margin start favoring private sector banks, because their cost of funds will start coming down further, come down more. It will come down for the public sector also, but public sector in any case had not gone up as much. So it will not even fall as much. Whereas in case of private sector, it could fall higher. So I think therefore to that extent, what you will see is that the margin expansion in private sector banks could be higher. But in general, because we are looking at a scenario of growth, we are looking at a scenario of economic cycle accelerating, credit growth also starting to build. Public sector banks also should do well. But in the recent years, what has happened is that, see, we had a phase when between 21 and 23 or 24, public sector banks were at a discount to private sector banks. And that valuation differential allowed public sector banks to do a lot better. Now, on the other side, in the last 12 to 18 odd months or maybe 2 years, private sector bank valuations have actually steadily kept coming down. And public sector has, as I said, gone up. So what has happened is that the gap is narrowed quite a bit. Now the scenario is attractive for both of them. Growth is likely to come back for both. Profitability also will improve, but improve more for the privates. And then you have a scenario where privates are not as expensive versus what they were earlier. In fact, the valuation differential with the PSUs is not as much anymore. So then privates therefore become as a choice somewhat better placed or somewhat more attractive compared to the PSUs at this stage. But there are a couple of PSU banks, the high end, the ones which we own, State Bank of India, Indian Bank. These, to our mind, are also emerging as very decent quality franchises. They are competing with private sector banks, on head to head on various parameters, and therefore they also remain banks of choice even within the overall, within the public sector space. So I think it's not that we don't have ownership in PSUs, but we restrict ourselves to a little, just a couple of them. But at this stage of the cycle, I would say that in our scheme of things, the preference is somewhat higher for private sector banks versus public.
So Ms. Parul Pandya is asking a question: what is the reason behind market being double after COVID, but certain mutual fund NAVs have not been able to deliver those kind of returns?
So I'm not really sure of which are some of those funds which have probably not been able to outperform the market since COVID, you're saying, right?
Since COVID, yeah.
So it could have been, the nature of those strategies. I mean, if they are like for example, they are one mid-cap fund versus another, then it was understandably a function of how much risk you have taken in the portfolio. Last 2-3 years have been the time when market has rewarded risk taking. So more volatile, more risk taking has led to better returns. Even in the same two mutual funds of that same category, there could have been a very significant difference. For example, a mid-cap fund, as you know, you have to have a minimum of 65% in mid-caps. Small cap fund, a minimum 65% in small caps, and so on. Mid-caps and small caps in general have done about 10% higher than large caps in the last 2-3 years in terms of CAGR returns. Now imagine a fund which has 65% in mid-caps, a mid-cap fund which has 65% in mid-caps, and another mid-cap fund which has got 85% in mid-caps, or 75% in mid-caps. 10% higher allocation to mid-caps, and if you have 10% higher return compared to, let's say, large caps, you could have easily made another 100 odd basis points of extra return just on account of your allocation in a mid-cap fund. So, as I said, your allocations would have mattered. If you have been at the lowest end of your mid-cap or small-cap allocation in your fund, and if you have been at a higher end, your return differential could be quite different on a 2-3 year time scale. So I think it's a function of the way the fund has kind of structured itself, the positioning that it has taken. If it has identified the cycle right and it has maximized its small cap, mid cap allocation, it could have done easily much better. Even in a mixed fund, like a hybrid fund, a multi-cap fund or a flexi-cap fund, again, there too, your allocation to mid cap, small caps, typically in my view, that has been one major factor which has created a difference in the returns between two schemes of that same category. One flexi cap versus another flexi cap, just see the differential between their allocations of mid cap, small cap, and it will explain a good part of the return differential. And the second thing is, again, out of that same thing, it could be the mindset. If the mindset has been more conservative, then it will not have led to that much of outcome. And if the mindset has been somewhat more aggressive, usually those funds would have generally done well. So in my view, I think very statistically, that has generally, when I have seen performance differentials, I have figured that it is as simple as how much allocation has been made to every asset class.
So just I'd like to add a little bit with the paucity of time as well. Most of the investors look at more on the recency bias as well, and look at investing on the funds which have done well in the recent past, and not ignoring some funds on basis of fundamental, but still they are down. Yesterday I was just seeing some chart which is showing about a 1 month return in a particular fund which we are not able to allow, which our country does not allow us to invest in, has delivered 43% in 1 month, absolute returns. This was an eye-opener, but we can't invest in such funds, and that is where. And it's one of the major economies of the world. It's not a small economy as such, but we don't have an option to invest. And at that point of time, the things were looking so bleak that nobody was looking to nobody even bothered even checking or ask. So that is also the investor gap. There's a chart which talks about investor returns versus the the gap between the investor return and the expected returns.
Yeah.
Because the market ends up giving you, but we don't stay invested for that kind of a period to deliver
The
to get
scheme
that kind
returns
of a
and the
return.
investor returns are different actually, because but one thing which I was mentioning, so since you brought that thing, that it is not always the good idea to buy only funds which are based on past historic returns or more recency bias, recent return trends. You may be at the bottom of the table, but you may be at the bottom of the table not because you have made some big mistakes in terms of your investing. It may just be because the mandate of the fund is different, and that mandate does not work during that market cycle. So it does not necessarily mean that it is. So for example, I'll cite you an example of our own Invesco India Contra Fund. Between calendar year 22 and 23, we did not have we were at the bottom of the table more or less in the peer group. But we were still outperforming the market. We were beating the BSE 500 quite well. But when we looked at our peers, they were always ahead of us for 2 years almost in a row. And that was because that was a period when it is in the value category. It's in the contra stroke value category. Now, one contra fund manager can have a completely different approach compared to another contra fund manager. And one might have a completely different risk-taking ability versus another. So if you've not taken those kind of risks, it is quite possible that you did not. But that doesn't mean that the process is flawed. So that is why I insist on the fact that, when you're doing your due diligence about picking a few funds, and you don't, beyond the point, I don't think one needs to put money in 20 different funds. I think 4 or 5 funds are probably enough, for a end investor's perspective to actually, create a portfolio. So if you can do your due diligence more in terms of what the fund managers or that organization's approach has been, philosophy has been, if they've stuck to that, irrespective of what the market has been doing, I think that is what you have to focus on, because markets will keep varying, cycles could be different. Sometimes this is preferred, sometimes something else is preferred. Sometimes it is a growth-oriented approach, sometimes it's a value-oriented approach. So, but if the fund manager is consistent, over a period of time it will recover. And that's exactly, so if I look at again my contra fund, we are now back to the top of the table in the matter of the last 1.5 years, because market circumstances are somewhat changed. We have not made some dramatic changes to our portfolio, in fact hardly anything. If you look at a fact sheet of today and fact sheet of 1 year back and 2 years back, you will not spot a lot of differences. But we were bottom of the table, now we are top of the table. So, but we have kept the philosophy the same, the process the same, the approach the same. So I think if you can figure out in advance as to how your fund manager is going to conduct his portfolio and manage your money, I think that is the way. And if you like that, if you think that suits your risk appetite and your approach and your requirement, this is how you should go about selecting between thousands of these funds which are there in the market.
So last couple of few questions, we'll just take it up because of the paucity of time as well. Mr. Dharmveer Chand Rajan is asking, please explain moderate risk. Yeah.
No, so by moderate risk, I basically mean, if you are looking for, let's say, a 15% kind of return, and if your fund volatility is and which is basically, let's say market return is likely to be more like 12-13%, but if you're looking for a 15%, 16% type of return, 2-3 percentage points ahead of the market, a commensurate volatility either measured by the beta of the portfolio, or there are a few other statistics to look at. It should not be, for that extra 20% return that you're getting, 13 versus 15, okay, you should not have volatility which is more than 20%. Versus the benchmark volatility. So that's what I mean by taking, so your volatility will be higher, but not significantly higher for that extra return that you are taking. Okay, so I think if you get a fund, let's say, which can deliver 15% return, but market volatility is the same as fund volatility, that is a good indicator of the fact that you're getting better returns, but at moderate risk. You're getting it at market risk. Okay. If you want, if that is not the objective, you are happy even with an 8-9% return, then you should look at a fund. Then the volatility of that fund should not even be 1, it should be 0.7, 0.8. which means that you are settling for lesser returns, but you are settling for even lesser volatility than that of the market, which again is a good outcome. So that is how you have to think of it. There are ways to do it. There are some technical parameters that we have to look at in order to be able to judge that, to say that this is a moderate risk fund compared to the, what you get in that SEBI language of moderate risk, high risk and all that, that is not, it's not the right way of looking at things. You should look at a few other parameters. We have our education videos which keep coming every now and then. For example, these days we are carrying that video about what is information ratio. Okay, that is exactly about risk. As to in getting a certain level of return, what is the type of risk that that fund has undertaken. That is what is information ratio. This is something which is now encouraged by SEBI to be disclosed by every fund on a regular basis. So SEBI is doing its job in terms of making investors understand what is the risk level of every fund. And I think that is a very important tool. So information ratio, there is Sharpe ratio, there is Sortino's, and a few of them are very technical, so I don't want to get into that. But I'm saying that we will have to familiarize ourselves with a little bit of all that in order to, there are small, simple explanatory videos that we are carrying on our website, etc. I encourage people to, many of you to look at it, and that will help you in making some conclusions about some of these things.
So Mr. Dinesh Bhagelkar is asking, which is best, SIP or lump sum investment, investing in FD versus mutual fund?
Mutual funds hands down versus FDs for sure, and FD rates are in any case now going to come down even further in our falling interest rate environment. SIP versus lump sum, I would definitely say that it all depends on where you are in the market cycle. I mean, if it is somewhat very adverse, I usually encourage people to encourage lump sum investments. So for example, a couple of months ago in February, March, when the market was undergoing a lot of weakness and there was a lot of anxiety and fear and so on, we were encouraging lump sum investments. That lump sum investments also need not necessarily be everything at one go. You can break it down into 2-3 tranches, 3-4 tranches. But it gives you that ability to actually take advantage of those market situations and commit more capital at that point in time when, because then, as I said, these chunky investments that you make at such points of time in the market cycle when things are weak, they make a lot of difference to your end returns 3 years later, 5 years later. When you look at your CAGR returns, you will see the difference that you will probably be 200 basis points ahead compared to what you would have otherwise done if you had not if you had even done only SIPs during that time. So there are times in the market when you have to take that courage, leap of faith, and commit some lump sum investments. And then you always have your SIP streams which can continue alongside with. But there are those instances when you have to put those lump sums to work. That does makes a lot of difference to your overall returns. Not immediately, but you will notice that 3 years on a 3-year CAGR, 5-year CAGR, you will definitely see a lot of. It is like even in individual stocks, we as fund managers also, not that when we buy a stock in our portfolio, we buy everything at one go. We buy some of it, we then wait for how the company progresses and so on. Or sometimes when we see that for whatever reason, external reason, the market reason or whatever, stocks have fallen, prices fall, we increase our commitments. Especially if we are not worried about the fundamentals of the company, then we increase our commitments at that time. So we also look for those type of opportunities even while making individual stock selections. If there are drawdowns in the market, use that opportunity to build, because then your overall returns in that stock becomes materially different after a while.
So Ms. Parul Mathur wants to understand briefly, why has corporate investments not picked up as expected since 2014, since government has been doing all the heavy lifting in the economy for some time now?
No, so I don't think that is exactly right. So when we look at, so there are different types of data. You see data regarding private, I think what she's talking about is private sector investments. Yeah.
That's right, sir.
So in that, there are these high frequency data which is about project announcements by the private sector and new project completions and stuff like that. I think that data is not very smooth, and it is very, noisy and at the same time is quite volatile and not exactly doesn't capture. I think the data which we look at is again a technical term, but it is called the gross fixed capital formation, GFCF data, which comes from the government, which comes from many of the statistical organizations. So there is private sector, so gross fixed capital formation is a better indicator because it is about the money which has actually been spent instead of the announcements which are being made or whatever, so that, because that is prospective, but this is what has actually been done. So if you look at the data of the last 2 years, gross fixed capital formation has grown at something like 17, 18% CAGR in the last 2 years. And in GFCF, we have got 3-4 components. One is government capex, the other one is private capex, then we have what is known as housing capex. In household capex, it is about houses, buying a house and other, so in capex or household, it is mainly large component is buying or constructing a house. Okay, so if you look at these 3 components, in that overall is 18%, within which private sector has grown at about, private sector GFCF has grown at 15%. The fastest growing part has been, because real estate has done so well and housing has done so well, that has grown at 22-23%. And your public sector capex has grown at about 17-18%. So in a way, government capex has grown faster than your private capex, but 14-15% CAGR even for private sector capex is not bad. And particularly if you were to look at the prior 3 years or 4 years, between 2018 and 2021, that was 5%. Same number for private sector capex was 5%. So versus that 5%, it has been 14-15, but somewhat slower than the public sector capex of 17-18. So I think if you look at it that way, the numbers don't seem to suggest that private sector has not participated. We also have to acknowledge the fact that private sector capex, the nature of capex has been different compared to what it traditionally used to be. Earlier, it was a lot of oil and gas, petrochemicals, refineries, heavy capex that used to come in 2010s, 2015s, that period, even 2000 to 2010 period. Today, the capex is more about power. It is about metros. It is about renewable energy, solar, wind. Now, those are not very high intensity, as high intensity as what it used to be in a steel plant or a petrochemical plant and so on. So the nature of capex is somewhat different. But yet, I think it is quite decent. And if we look at it from these numbers, the hard reality doesn't seem to be as bad.
So there's a question online. One or last 2 questions that we can take up. Mr. Raju Ranganathan has asked, what could be the impact of the growth and investment, particularly FPI, due to the recent India-Pakistan war-like aggression and renewed threat of terrorism going forward?
So at least the evidence, as I called out, I think keeping war aside, but in general, I feel that given the way the global growth scenario will likely develop, and this whole tariff-related scenario which is unfolding, and the fact that the US itself wants the dollar to weaken, at some level, I think this will encourage emerging market flows, and therefore emerging market flows should increase. Some trends are already since April onwards. So for example, between September 24 and March of 25, we saw net outflows of almost $45 billion. Since then, from April onwards, actually that has started to reverse. I don't exactly know the number for the last 1.5 months, but 2 months, 1.5 months. But I think it is positive. Just recollecting from the daily numbers, it doesn't look like it will, it has clearly improved materially. So the trend, still very early days, just 1.5 months data, but the trend has started to materially reverse from a very heavy outflow of $45 billion in a space of 6 months. Trend has shifted. And more particularly in the more recent few days, when in the last week in particular, when we have been going through this war-like situation, yet flows have been positive. In fact, on 2-3 days of the last week, if I recollect right, FI numbers were positive and domestic numbers were negative. So actually, if you go to see, foreign investors are not necessarily exactly taking a very dim view about the overall about the war situation that we are going through today. Perhaps they are even looking at that as an opportunity, because these are the times that you get those opportunities to be able to invest, and you get the liquidity as well. So I broadly, I do not think that this will, unless it deepens to a level which is not very healthy, or gets to a stage where we have to really think about a very aggravated scenario, which I don't think, for various reasons, both the countries would want to probably get to that stage. I would like to think that foreign flows will continue to remain positive and will not be as much a function of geopolitical conditions. They will be more a function of what happens to trade conditions. I think trade war will be a bigger determinant of the benefits to flows than the Indo-Pak war.
So just one last question by Mr. Chandrabhan Rohra. Which MF is better for SWP for 25 lakhs?
I don't think I should be. I mean, Invesco, of course. But I think we can do that evaluation and even look at some of the schemes. But I don't have a top of the mind answer.
Yeah, so any fund that can deliver a 12% return with a 6% inflation and 6% withdrawal will be good enough for.
There you have your answer. So, yes, please.
It's on communication, from the fund managers to the distributors to the retail investors, mutual fund investors. We are common normal people who are investing through the distributor in the mutual fund. But when the market is volatile, what kind of communication should be there between the between the fund manager, distributor, and to the clients? Because I have been bothering Rahul a lot on this.
No, I think we look.
Because that reassurance is always needed. We are putting all our money through these people, through a distributor, through you.
No, this is exactly the reason why we are here on a Sunday morning. So, but having said that, I think we are, I mean, at least at my level, I can say, I can't talk for others, but I can talk for myself and my firm. We have generally been open to, holding hands during periods of, well, not so good periods, or periods of crisis, or periods of high volatility. We have never shied away from communicating our thought process, our approach to our investors. We have multiple forums. I talk to people on daily basis, in various distributors come to us even on a personal one-on-one basis, and we talk to them. So we have kept I'm a great believer in the fact that, when chips are down and when things are not as great, that is a time to actually go and sit in front of the client and actually give them your thought. You could be wrong, you may not have, you may still, I mean, it may not work out the way you expect, but I think that is very reassuring and to the investor, and that is what investors, or anybody else for that matter, would recall at the time when things start to improve. I mean, when things start to go the right way, the first port of call will be the guy who came and sat with him and had a coffee. He may not have helped him in any other way, but at least that building that confidence at that point in time helps. And it's like any other business. I mean, it's not only about selling mutual funds. Selling any other product, and if it doesn't do well, and if you actually handhold them at that time, it's about building relationships ultimately, right? So I think we've, at least I have personally believed in that. In fact, I remember this time after COVID, between 22 and 23, when it was not about market volatility as much, it was about the time when we were not doing as well as a firm. I mean, we were somewhat underperforming. I told you our contra fund was at the bottom of the table and so on. So we had a lot of, interactions with investors. We traveled. In fact, at that time, internally, my boss used to tell me that you need to be on the table and rectify the portfolios and do well, and ensure that the team does well and deliver the make up for the performance and all that. I said, that's fine, we will do that as well. But it is also simultaneously important for me to be in front of the investor and tell him what has gone wrong, what are the corrective actions that we are taking in order to set that thing right. And I think we did that extensively in the course of 22. And thankfully, God had been kind, and we, since late of 23, we actually started to meaningfully improve. And we had a very strong reversal of performance, thanks to the efforts of the team, everybody, and so on. So at that time, that interaction helped us a lot. And in fact, it went on to build so much of confidence that we were able to empanel new distributors. People who had not seen us earlier came back. They appreciated the fact that we had interacted with them. So I think we are open. I mean, we are our doors are open for those interactions. We make communication. We hold quarterly conference calls. I just did one for this quarter 2 days back on Thursday or Friday. We do that once in a quarter where everybody is free to join. And I personally conduct that call. I try to give my views and what we think going ahead. We do that very regular every quarter for 4 quarters. We prepare this deck every quarter at the end of every quarter. So this is just fresh out of the oven last week. And on the basis of this deck, then we go and do this pan-India call. Otherwise too, even on a daily basis, if not daily, at least on a very frequent, regular basis, I get so many requests from various distributors, me and my team, and we try to engage with them as much as possible. So I think, and in some of these things, we are a very process-oriented firm. So we have a very strong templated process that we follow, and we've been following since 2007, since the inception of this organization. So think of it, 17 years we've been doing things in the same. I've not had a chance to actually, take you through that in the interest of, due to lack of time, some other time if we get a chance. But it's a very, very elaborate process that we follow, and quite distinct from many other peers in the industry. And more importantly, we've been doing it consistently for 17 years. So we have not changed that, and it has helped us a lot, and it has led to the consistency of returns. It's sometimes 1 or 2 years here and there it happens, but because we have that machine, we keep to that conviction, and we say that we've seen that in the past, so we know that it will sort itself out. So I think that solves most of our problems. What I'm trying to say is that then I don't need to, I can challenge, I can manage, navigate most of these volatile conditions in the market. I don't have to worry every day. I don't go with sleepless nights कि अरे भाई कल मॉर्निंग का हेडलाइन क्या होगा और मैं क्या करूँगा, वो सब ज़रूरत नहीं है. ठीक है, those are parts of the market cycle, but we don't unduly fret about it because we know that our portfolios are configured in a way in order to ensure that risk is by and large controlled. We've not had any accidents over the since our inception, thanks to the process, because that process filters many of these possibilities where accidents can occur. Even something like a Satyam, going all the way back to Satyam Computers, if you people can recollect in 2007, 2008-9 when the company went bust. Okay, surprise, I wasn't there in the firm at that point in time, but thanks to our process, none of our funds had even a single share of Satyam on the day that episode happened. And it was not just about chance. It was not about luck. It was because that stock did not go through our investment framework. And because it did not go through our investment framework, we have this discipline that if it doesn't go through, then we cannot buy it in any of the funds. So it was not bought, and we were surprised ourselves that it's happened on even few other recent examples also. That we have managed some of those. We have not been present in many of these names, and we have escaped the wrath of that time. So I think sticking to the process, having that discipline, that is something which has helped us a lot, and that's why for us, we are able to spend that extra time and connect with it, because I don't have to worry and I don't fret about my portfolios on a daily basis. Yes, we do our due diligence on a daily basis, but it's not that आज तो गिर गया ये 5%, अभी क्या करूँ, कल बढ़ेगा 10%, अरे तो बेच दूँ, ऐसा वाला कोई आराम से जिंदगी कट जाती है, मतलब
So one last question, Mr. Dhingra would like to ask you.
जी.
Good morning, and thank you very much for your exhaustive and information explanation. I think under the sky of investment.
Thank you.
You have hardly left anything. Now, I put a specific questions, though I put it there. The timings. Everything is covered, discussed, everything, but when you have to invest, timings. Now, I have a surplus of 1 crore today, and I want to invest. Which are the products? Timing is good or not, and what are the percentages? This is a specific question after you have explained everything.
Timing, I think, is perfect. As I said on multiple occasions, we are positive. We think that one should commit money. We should probably, take advantage of the situation. When things are more complex, that is the time you get actually those opportunities. When things simplify, then you get returns. Okay, so it is better to buy at times of complexity. And especially if you're in a good position to have surplus and to be able to invest, you should invest. And if I don't know, but if that number that you say 1 crore is, let's say, meant only for equities, and obviously there's no debate. But if it is not, then I would still say that in that 1 CR of, or if 100 is a number today of surplus which is available with somebody, 50-60% should go to equities, depending upon your risk profile, several other things. But I don't think it should be 20-30. It should be a meaningful chunk. Second is that I think I'm not of the type where I think we should take a very defensive posturing. India is in that growth mode. There are opportunities in the broader market, as I said. There are newer businesses which are emerging. There are companies which are proving themselves. There are startups, there are established companies, and so on and so forth. But the mid-size and small-size space is where there is a fair bit of opportunity. It requires extra amount of due diligence, which you have to leave it to the portfolio manager, or if you can do it yourself, you should do it yourself. But I think that is a space which you should commit money. So even that 50-60%, I would say that starting from flexi cap funds, if you're a moderate risk investor, going up to mid-size and small-size funds is where I would distribute that 50 rupees of that equity money that you have for yourselves. Equally distributed is also fine. If you are a little more risk-taking, mid-cap and small-cap should occupy a larger portion. If not, then it can be somewhat equally divided between these three. And if you can bring in some of this whole thing, concept of multi-asset funds, make it a little more central, that is something which you can do as a fourth strategy. And last but not the least, I don't recommend more than five strategies. As I said, I don't think you need to have anything more than that. The last pocket where you probably want to do, if something thematic is what you want to do, or sector-specific fund or something like that. At this stage, from a risk-reward balance, I would think that banking and financial services is one fund that you should probably look at from a sectoral standpoint. So I'll leave you with these 3-4, which probably at the top of our mind, this is what we have been recommending to our investors and clients in the recent times.
Thank you so much, sir. I would just like to invite Purti to give you a vote of thanks for the lovely, wonderful speech and the question answer you have taken.
Thank you. Thank you very much, all of you, for patient listening, and happy to have been here. And look forward to many more interactions as we go ahead. Thank you. Thank you once again, Rahulji, Param Investments, for having me on this occasion. Thank you. Have a good day.
Thank you, sir, for the thought-provoking and such an interesting session. It was truly an honor to be here today attending this session. Your reflection on market trends, reduced earnings, expectations, and the broader economic outlook provided much-needed clarity. Your take on ongoing geopolitical tensions, short wars, and how their limited impact on the economy often creates short-term economy that creates short-term volatility can be used as opportunity was especially valuable. We also appreciate your insights on potential stagflation in US, the rise of Chinese technology, which will attract global investments, and however, it will not affect India much because of its strong IT foundation. Remains and India, how India remains comparatively resilient and full of opportunity. Additionally, your view on how a good monsoon could significantly boost our rural economic growth was encouraging. Um, Finally, how you told us about how India is still in a growth position because of its healthy balance sheets, low debt, and fiscal discipline reassured us about the country's long-term growth potential. Thank you, sir, for your valuable insights. Now I'll call Varsha ma'am to give a gift. So, I would request everyone to just give the feedback forms after you fill it to the RMs.
Thank you so much, everyone. It was a wonderful crowd, and we really liked hosting you all. Hope to see you all again next year. Thank you.